let's see the different financial contracts that can be found on the financial market. The first criterion is the nature of the financial asset used in the contract. The first type of financial asset are the shares issued by a company, conferring on the owner of the share, called shareholder, a right of ownership over the company, and the possibility of profit sharing, called dividends, and this in proportion to the shares owned in a company. These shares are sold and bought on a market called stock market. Some stock markets are specialized according to the size of the company or its nature. These markets publish an index that reflects the average change in the price of shares of the company listed on their market. The second type of asset is the interest rate paid for a borrowing of money. Of course, it's not the interest rate as such that we find on the financial market, but a financial asset called bond. A borrower, a company or a state, issued a security that allows the purchaser of it, the lender called bondholder, to receive annual interest on the amount purchased and to be reimbursed after a period of time. These bonds can be resold between bondholders at any time before the redemption date. The third type of asset are currencies that can be bought and sold according to the needs of companies or states, that for money transfers in a currency different of the national currency. This leads to exchange a currency against another according to a conversion rate which is fixed by the market. We have another type of asset, the commodities like gold, oil, wheat, minerals, and rare earths. The purchase of shares of a single company could be risky. That's why some banks offer portfolios mixing shares of several types of companies in order to create a diversification and therefore a possible reduction of this risk. Finally, we have markets proposing another type of portfolios called structured products that try to maximize the relationship between risk and return by mixing not only stocks or bonds, but also other types of financial assets or contracts, such as future and option. Let us come to this type of contract with the second criterion, the date of delivery of the asset. Now, let's classify the financial markets according to the delivery date of the asset. First of all, we have the spot financial markets, that's to say for which the delivery of the asset, bought or sold, is made at the same time as the decision to buy or sell. Then we have the different markets in which the decision to buy or sell is made on any day during the month, but the delivery of the asset bought or sold is only made one day at the end of the month. We have what are called future. These are contracts for which the underlying asset is bought or sold at a certain price on a given date, but delivered on another date within the same price conditions that were set beforehand during the transaction. Finally, the other type of contract are the options, for which an underlying asset is bought or sold, but the buyer of the option can decide at any time or just before delivery to cancel his act of purchase or sale of the underlying asset upon payment to the seller of a premium. The third way to classify financial markets is based on the date of creation of the asset. In other words, is the asset a new one or a second-hand one? This mainly concerns stocks or bonds. Companies that want to raise new funds can either expand their shareholdings by creating new shares or borrow by issuing bonds. This financial market is called the primary market. On the other hand, transactions between shareholders or bondholders for shares and bonds issued in the past are carried out on the so-called secondary market. Finally, we can consider a fourth method of classification, which is based on the method of fixing the purchase or sale price on the market. We have two methods: either the fixing of the price according to an auction system, which means that the fixed price is the one which maximizes the number of transactions between buyers and sellers. The other mode is called over-the-counter. In this mode, a seller or a buyer offers a financial asset at a given price and look for an agreement on price and quantity with someone interested.